Vishal sir, please take the charge of the session. We are eager to listen to you.
Uh, my seniors and friends in the profession, maybe, we'll directly jump to the subject on hand. And what we are going to really talk about today, is a topic on M&A. And I think the idea is to give a bird's eye view on the tax and regulatory aspect. Very, very difficult to talk of such a subject in, 75 minutes, but we'll probably try to touch mainly upon the income tax, a bit on GST, FEMA, SEBI, company law, depending on, what our time is. And maybe time permitting, we might have few questions at the end of the session per se. I think first I thought it's important that, as a practitioner, what is very important is to understand what is the business objective of our client group. Why are they proposing a particular transaction? Why are they proposing a particular merger, demerger, slump sale, whatever be that corporate action? Is it that they are trying to consolidate the business? If that be so, then there are options like merger, slump sale. Is it that there is actually an investor entry happening, which means there is a primary issuance, maybe some kind of a secondary sale? Then there is a need of certain capital restructuring, need to hive out certain non-core business because the investor may not be interested. Maybe need to do some tax planning because a secondary sale might result in a capital gain. Or are you simply trying to simplify the legal structure? Maybe as a group you have 30 entities, 40 entities, and it doesn't make commercial sense to run so many entities. So is your objective just merely to collapse and reduce the number of entities? Are you trying to take certain fiscal benefit? So recently we were working on a case where there was a fiscal benefit given to a subsidiary, and we wanted to simplify the structure by merging all these entities. But because the state government had given a fiscal benefit to a particular entity, we could not touch that entity. So we had to collapse all other entities into the entity where the fiscal benefit was given. Are you talking about some kind of a split in the business? Is there a family dispute or a family arrangement where different branches of the family will take over one business versus another business? Or are you preparing for a listing? Very important, right? If you're preparing for a listing, again, the considerations are important. This way, there could be multiple objective. And why it is important to keep sight of that objective? Because your subsequent recommendation, your subsequent planning, your subsequent restructuring option will follow what business objective you wish to follow. So that's the first fundamental principle before one enters into any kind of a M&A designing. I call it the 20 factor planning. So if you look at these boxes, there are exactly 20 boxes. And whatever you do, right, you will hopefully pass through most of these boxes. The first box is that of a tax neutrality. So whenever you are planning something, your attempt will be that, is it tax neutral? I don't want to pay a tax merely because I'm carrying out a transaction, collapsing entities, doing a slum sale, demerging it. Your second objective will be that if there are losses in the group, those losses should not get extinguished. If there is a change in control, section 79 gets hit, and then the losses get lapsed. So my second objective obviously will be that I preserve the losses. The third objective will be, is there a way to take some benefit, a kind of a side accidental benefit in the course of a restructuring? There is a case study which we have put in, and while the government has kind of put an embargo on depreciation on goodwill, can we still, in the course of a merger, create certain intangibles and claim depreciation? That's a very interesting case study, which we'll take it up. What is your overall tax strategy? Recently we are working on a share swap between a foreign company and an Indian company. And a share swap gives rise to its own uh, potential tax litigation. When you do a share swap, there is an issue whether the receipt of shares happen in India to the foreign shareholder, whether Section 5 gets triggered, whether there is a taxability on a receipt basis. What is your tax strategy? Are you going to take a tax insurance from a foreign insurer to defend against that litigation? Accounting standards, very important. Are you a company which follows the normative Indian accounting standards, or you follow the more advanced Ind AS? In the letter, it is very difficult to plan on an intangible depreciation and a variety of aspects. So there are certain limitations. So that accounting standard becomes important. Are you creating an intangible asset which will get amortized? And if you're a listed company, you will hate the word amortization because it depresses your EBITDA, it impacts your share prices, and you will say tax planning is a secondary objective. I want to protect my P&L. uh, what are your accounting ratios? Is the balance sheet cleaned up? What is the company law procedure you are going to take? Are you going to use the NCLT route or are you going to use the fast track route? There are few slides, we'll take few examples. SEBI regulations. If you're doing any restructuring above the company, which results in change of control, then there is a SEBI takeover code which gets triggered. Are you doing some kind of a shifting of shares into a private trust, succession planning? Is there a new legal entity or a new legal person which comes into being, which is now holding the shares? Would you fall under Regulation 10 exemption of a SEBI, or you'll have to apply to SEBI prior before you do any such regulations? Competition Commission. Are you doing a transaction which is about 2000 crore? Moment you do a transaction about 2000 crore, irrespective of your group size, de minimis transaction value, there is a requirement to go to CCI. Cross-border issues. What are you trying to do? Are you trying to merge an overseas company into India? Something which we are reading in the market. You have many tech companies which are trying to shift back into India. For example, Dream11 recently folded back into India. They are all preparing for India listing. But moment you have an overseas entity, you have FEMA issues coming in. You have issues which are there in the foreign jurisdiction. Valuation consistency, right? This is of course the most creative of all part. There are valuation norms under income tax, there are valuation norms under FEMA, there are valuation norms under company law, and you want to try and make everything consistent about it. So swap ratio, stamp duty costs, very important. Which state are you in? For example, till recently, Gujarat used to be a very popular state to migrate certain mergers, especially of unlisted companies, because you could plan your stamp duty. There, the stamp duty was 1% on the face value. Just recently in April, they have changed that. So now which state do you go to? Would you go to Chennai, where till now there is a zero stamp duty on non-immovable property merger? So you will keep on looking at states, arbitrages, places to move your restructuring to save stamp duties, legal liabilities, business integration, and the most important, time factor. Sometimes we come up with the best option, but that is going to take 10 months, 12 months, and the transaction would not survive that long. So the real world, you have to be very practical to say what is the time we have, and vis-a-vis that time and the cost constraints, what is that design, what is that option, what is that M&A restructuring we are able to fit in. So these are, as I said, very important key considerations. And only after giving a thought to each of these 20 boxes, you then come up with a scheme, a recommendation, a design which basically suits all the parties involved. Now, with this conceptual background, we can jump directly into some of the M&A options. Typically, as you are aware, there could be merger of companies, there could be demerger of companies, there could be divestment. Divestment could again be of a slum sale or a share transfer. And we'll take up one slide that would you do a business sale or would you do a share sale? What works best for which entity? There could be a capital reorganization in the form of a buyback or a cap reduction, and there could be conversion. You are an LLP trying to convert to a company, or you are a company trying to convert back into an LLP. What are the complications, restraints? In most cases, you will see that an M&A design is a combination of one of these options, and then obviously you have to customize what suits best. Let's first take, I'll come to this slide later where we'll talk about some of these regulations, but let's first take a simple question of a business transfer versus a share transfer. It's a classical problem. As students of M&A, we are taught. There is a seller. The seller is interested in a particular business. The seller approaches, the owner saying, I want ownership of that business. And then there are commercial discussions. There are two ways you can transfer the business. Either you can transfer the company itself to the buyer. That's option number one. And option number two, instead of transferring the company, you will transfer the business. So the legal entity remains intact, but the business gets transferred under a slum sale arrangement, and the money comes inside the business or inside the legal entity. In the first option, the money comes directly to the shareholders. And which option is best? There is no best option. It depends on what you want to achieve. So let's take a small comparison. From a buyer perspective, the buyer would say that if there are significant historical liabilities, contingent liabilities, then I would not like to touch your legal entity. I would rather buy your business. I would rather pick and choose the assets, liabilities, contracts, people which I want. And I will be comfortable because your liabilities, your contingent liabilities remain in the in the legal entity. So if historical risk is a very big factor, then the buyer will shudder from touching your legal entity. Second, from an acquisition perspective, so if the buyer is basically taking a loan, and after taking a loan, it is going to fund that acquisition, then an acquisition of share, you don't really get a deduction of interest because you have acquired a capital asset and your interest sits in the balance sheet where you are not able to claim it as a Section 37. But if I have acquired a business after taking a loan, it is much more easier for me because there is a specific code under Section 36. So if this is a leverage deal, which means that the buyer is actually taking a debt to fund it, the buyer would be more keen to buy the business rather than the legal entity so that he can claim a deduction of that interest. Third, as I mentioned, if you buy a company, with the company, all the assets come, all the liabilities come, all the contingent liabilities come, you can't choose. But if you're buying a business, there is a cherry picking of assets. There is a cherry picking of liabilities. You can choose what you want. You can create your own combination. However, if there are carry forward losses in that company and I'm only buying the business, then the losses remain. I'm not able to find a way to utilize that losses. So many times the buyer is very much interested in addition to the business, also with the losses. In that case, the buyer will find a way to buy the legal entity in such a way that the losses also get transferred to it. In that case, you will actually see buyer more keen to buy the legal entity rather than to buy the business. Step up in costs, tax depreciation. This is again a very important point. If I buy a company worth 100 crore, that cost, that payment which I have made sits in my balance sheet as investment in shares, but I do not get a tax break. But instead of using that 100 crore to buy the shares, if I buy the business, then I'm able to allocate that 100 crore against each of the asset and liabilities and actually start depreciating the value of the assets. And therefore, from a cost step up and depreciation perspective, I would love to kind of buy the business rather than to buy the legal entity. However, now we come to the seller. We have been talking about the buyer. The seller says, wait a minute, we have only been talking about your advantages. But if I sell you the business, first of all, I will have to pay tax in the company. After that, when I try to extract the money out, I have to pay a double tax. And therefore, you will always see a seller resisting a sale of business, especially when that business is the only asset in the company, because it leads to a double tax, especially if the ultimate aim is to distribute the money back to the shareholder. You effectively have a long-term capital gain in the legal entity. After that, whatever cash surplus is there, when you try to take it out as a dividend, you have an additional 36% cost. So when the ultimate aim is that each of the shareholders, each of the sellers take their money and go home, they will resist ferociously in selling the business. They will say, sorry, nothing doing. You buy the shares directly and make a payment to me directly. Then you do whatever you want to do with that entity. Because when you buy the shares directly, I get the money directly as a shareholder and I only suffer a one level long-term capital gain. This is one of the classical dilemma. So there is never an easy answer whether you should buy a business or whether you should buy a what you call a legal entity. And therefore it depends on who needs what, which are the factors relevant, and you will finally come to a compromise between the two parties where certain parties will have to concede certain benefits. Uh, let's move from a business purchase versus a share purchase to a typical merger option. In a merger option, two legal entities become one. So you have A Limited, you have a buyer which is B Limited. The buyer says, you know what, I don't want to pay you cash. I want to pay you in shares. A classic example is when, Hindustan Unilever, they basically bought in, the brand Horlicks. They effectively merged the company which had that brand. They did not buy it directly. And after merging, the shareholders of Horlicks company were actually issued shares in the Unilever company. And then the shareholders would have done whatever they want to do with the shares of Unilever. So this is a example where the buyer will effectively tell the target company that why don't you merge within me? I will issue you shares, and that's it. And then you do whatever you want to do with the shares. In a merger, you effectively are trying to pull the two companies together, combine your people, all your assets, all your liabilities. You are not cherry picking the asset. And normally, this process of merger goes through either an NCLT approval or a fast track approval if both the companies are small companies. What are the typical conditions attached for a merger to be a tax neutral exercise? These conditions are provided in section 47. First condition is that in the course of a merger, all assets, all liabilities of the amalgamating company should come to the acquirer company, or what we call the amalgamated company. Second condition, the shareholders of the target company, three-fourths of them should receive consideration in the form of shares. So for instance, in the current example, if the buyer company is merging A Limited and it is issuing, let's say, shares only to 50% of the shareholders, but it is paying cash to the balance 50% of the shareholders, then from an income tax perspective, this combination is not tax neutral. There will be tax consequences. But if, let's say, typically A Limited gets merged and the buyer company is issuing shares to all the shareholders or up to 75% of the shareholders, then there is no tax implication on any entity other than those shareholders which have received cash. Those who have received cash will suffer a capital gains tax per se. Rest, all the shareholders, all the legal entities will typically be regarded as tax neutral entities. Here, there used to be a very interesting planning available, which has been clubbed from the current financial year. Whenever the losses were about to expire, because we could carry forward losses only for 8 years, and let's say 2 years are left, and you merge that company with another company in an appropriate compliant manner, then those losses used to get a fresh lease of 8 years. This was pretty interesting. Some companies have done it. However, from the current year, that provision where the number of years of carry forward of losses gets reset to zero has been completely eliminated, which means that if 6 years have elapsed and there is a merger, then the new amalgamated company can only get a carry forward for the balance 2 years. So this planning is no longer available for the current financial year. Also, typically what happens is that in the first year when there is a merger, the depreciation between the assets are divided between the number of days. So if let's say the merger happens on 1st of October, which is mid of the year, then whatever depreciation was available on the assets, 6 months will be given in the earlier entity and 6 months will come in the new amalgamated entity. It's a simple mathematical on a proportionate basis. Also, a merger has certain disadvantage. So if, let's say in our case, A Limited, which is the target company, was availing certain tax holidays such as 80IA, let's say, production of power, etc. On a merger, these tax holidays get lapsed. So you cannot avail the tax holiday in the hands of the amalgamated company. So you have to be very careful that the entity which you are merging is not availing certain tax holidays such as 80IA, 80IB, because on merger, those tax holidays stop accruing to the new owner or to the new setup per se. I'll not get into these specific sections. Obviously, a copy of the presentation would be made available. The idea is to explain, the basic concept. We spoke about a merger. What is a demerger? A demerger is very similar to a merger, with the only difference that in a merger, the entity loses its significance. So in our earlier example, when A Limited was merging into B Limited, the legal existence of A Limited was completely concluded. A Limited ceased to exist. All the businesses, all the divisions, all the assets, all the liabilities moved into B Limited. In a demerger, number one, the legal existence of the company continues. That is the most important differentiation between a merger or a demerger. And normally, you will do a demerger when you do not want to transfer all the businesses, all the divisions, but you want to transfer only specific businesses or specific divisions. In this example, let's say A Limited actually has two businesses, business X and business Y. And the buyer entity only wants business Y. It does not want business X. In this case, you will again go to an NCLT or a fast track route, and business Y will be shifted to B. B will issue shares to the shareholders of A, and this is a classical corporate restructuring, what we call as a demerger. In this case, A also continues to exist, but now A has only one division, which is division X. B obviously continues to exist, but now all the assets, liabilities, employees, etc. of business Y that has shifted to the B Limited. This is typically what you call a demerger. From a pure business perspective, it has the same effect of combining a certain business with the acquirer. From an income tax perspective, there are few niceties, and maybe we'll touch upon it. The first important condition here is that what you can demerge is only and only a business undertaking. If certain combination of assets and liabilities do not constitute an undertaking, you cannot do a demerger. And I'll give you two very vague examples. Let us say we want to do a merger. Company A has no business. It has certain passive assets such as some computers, some land, etc. But there is no business activity. You can definitely merge A into B, and there is no requirement to demonstrate that there was a running business which got transferred to company B. And this could still be a tax exempt merger. But when you are trying to do a demerger, you will have to group certain assets and liabilities, show that it's a running business. They themselves create an independent business in itself, and only then you can do a demerger. That is one of the most important criteria of a demerger, that what you can demerge is only and only an eligible undertaking. The second criteria is that all the assets and all the liabilities which are attached to that business, they have to be shifted. You cannot cherry pick. You cannot say that, you know what, I'm transferring 98% of the assets and 93% of the liability of an undertaking under a demerger. It is okay from a company law perspective. It is not okay from an income tax perspective. 100% of the liabilities, 100% of the asset of an undertaking needs to be moved. The other conditions are same, which means at least 3/4 of the shareholders of the old target company should actually get paid in shares. These shares could be equity shares, these shares could be preference shares, these shares could be convertible shares, these shares could be redeemable shares, it does not matter, but the consideration should be in the form of shares. Also, there is one more nicety in demerger, which is not there in a merger. That nicety is that whatever you have demerged in the resultant company or in the acquirer company, they have to be recorded at book value. You cannot change the values. The only exception where you can change the values of these assets and liabilities is where the acquirer company or the or the resulting entity, as we call it, is following Ind accounting standard, and there is a compulsion under Ind accounting standard to record these assets or liabilities at a fair value. That is the only exception. Otherwise, your accounting has to happen at a book value. So whatever was recorded in the books of the target company needs to be recorded in the books of the acquirer company. The only exception being compliance with Ind accounting standard. So these are some of the, I would say, typical conditions. Unlike merger, where till last year there was a planning available of a fresh lease of carry forward losses, there was never a requirement, there was never an entitlement of a fresh lease. So even in the past, when demergers used to happen and the old company has kind of carry forward the losses, let's say for 6 years, then the new resulting company only was eligible for a period of 2 years. So to that extent, the government has brought what you call a merger and a demerger almost at par, with each other. There are certain mathematical formulas. There are times where you are not able to relate to what losses relate to this undertaking. Sometimes the losses are mixed. There could be multiple businesses, and sometimes the carry forward losses could relate to more than one business. In this case, certain formulas are given where they are saying that you transfer the tax losses from one entity to another in the ratio of the assets which are getting transferred. So if the old target company, or what we call the demerged company, had a gross asset of 100 rupee, and you are transferring 30% of that asset, then 30% of the tax losses can be transferred to the new resulting entity. However, if you are able to determine that this particular loss relates to this particular business division which we are trying to demerge, then you are able to transfer all these losses to the resulting entity. To that extent, we have seen a demerger tends to be much more complicated. You have to be very, very precise in your planning. You have to be very, very precise in your calculations, because a small error, and it gives a chance to the tax office to say that you have not complied strictly with all the conditions of a demerger transaction. Again, similar to a merger, moment you do a demerger, certain tax holidays such as ATIA, ATIB, etc., they get lost. So you cannot kind of revive those tax holidays. Now, in the real world, what happens is that if you are doing an internal group restructuring, it is very easy to do a merger, demerger. Depending on the state, it can take 4 months, 6 months, sometimes 8 months, sometimes 10 months. You're okay to wait. But if there is an actual transaction waiting at your door, then the buyer has no patience to wait for such long. Buyer says, let's do the DD, let's sign a term sheet, right? Let's sign an SPA, let's do the closing, let's complete everything in 3 to 4 months. So typically, we have seen that whenever there is an external transaction, barring some exception, mergers or demergers are a rarity. Hardly 10 to 20% of external transactions would be through a merger or a demerger. They would typically be through either a share sale agreement or a slump sale agreement. And therefore, you will see a slump sale agreement or a share sale agreement being more common, more popular when it comes to external transactions. And what is a slump sale? Simply speaking, a slump sale is nothing but a business sale where the legal entity remains intact. You are selling the business and the money also comes in the entity. The shareholder directly does not get anything. So in this case, let's say B Limited does not have the patience to wait for a demerger and it wants the division Y in a hurry. Then A and B Limited will enter into a business transfer agreement, which is a commercial terminology. The tax terminology is a slump sale agreement. And under that agreement, business Y will get transferred to B Limited. Unlike the requirement of a demerger, where you say that all assets, all liabilities have to be transferred, a slump sale agreement can be a cherry pick one. You can pick up 93% of the assets, 97% of the liabilities, keep some employees behind. You can design the business which you are transferring. The only condition is that whatever you are transferring should be on a going concern basis. As long as you do that, a slump sale agreement works. And obviously on this transaction, you will pay a slump sale. There was a time, couple of years back, where people would enter into what you call a slump exchange to avoid paying capital gains tax. What was a slump exchange? Business Y is being transferred to B Limited. B Limited is not making a payment in terms of cash. It is issuing some securities. It could be equity shares, it could be redeemable shares, it could be debentures. And under that slump exchange, there were host of case laws right up to High Court, which said that this is a slump exchange, it's not a slump sale, so you cannot levy a capital gains tax. Then somewhere in AY 21-22, some 4 to 5 years back, the government changed the definition of a slum sale, which meant that a slum sale is a sale of an undertaking by any means, It need not be just by way of a sale, because moment you use the word sale, it takes you to Sale of Goods Act, and under Sale of Goods Act, a barter is not regarded as a sale. It has to be for money. Therefore, they said that it does not matter whether the acquirer is making you a cash payment or a payment in kind. This will still be a slump sale subject to capital gain. So the concept of slump exchange has now been done away with. Uh, Whenever you do a slump sale, it comes under a special code to compute capital gains. That special code is enshrined under section 50B, where there are certain formulas, as to what is the cost, what is the deemed consideration. We'll not right now get into it, but there is a rule 11 UAE, which effectively follows the deemed book value, what we have in section 56, to ensure that this is the de minimis value which you should pay. Just to give an example, let's say the book value of my undertaking as per books, and let's say I have no real estate in my books, is around 20 crore. I cannot do a slump sale at 15 crore. If I do a slump sale at 15 crore, it is still deemed that I have received 20 crore because my book value was 20 crore. So they have brought in some kind of a minimum threshold, at which the slump sale would be regarded have effectuated per se. Again, similar to a merger or a demerger, your depreciation will be on a proportionate basis. So when you transfer your assets, let's say, on 1st of January, the new owner will take depreciation for 1/4 of the period, and the old owner will take depreciation for 3/4 of the period. And after that, obviously, the new owner will take it forward basis its WDV, etc. Here, interestingly, unlike a merger or a demerger, where your tax holiday under section 80IA or 80IB could be jeopardized, here in a slum sale, there is no such risk. So if let's say you are into a 10-year tax holiday period, you have taken 4 years of tax holiday benefits, 6 years are remaining. When you transfer that undertaking to a new owner under a slum sale, the new owner can take the tax holiday for the balance 6 years per se. So frequently we have seen that when you are transferring business undertaking, which is basically availing a tax holiday, a merger or a demerger is less preferred. A slum sale is the way to go about it. Now, why don't we go to the next type of a restructuring, which is a capital reduction. And as the name suggests, you are a company, and under a company, you are reducing your share capital for a variety of reasons. Now, let's say there is a company which has 10 shareholders, and each shareholder is holding 100 shares. Your capital reduction could be of two categories. First is where the number of shares remain the same, but you are reducing the face value. So if let's say the face value of the shares is 10 rupee, I'm reducing it by 4 rupee. So the new face value is 6 rupee, but the number of shares remain same. The second category of capital reduction is where you're canceling those shares. So the number of shares reduces, but the face value remains intact, right? And mathematically, both can come to the same commercial result, what you want to do. Effectively, from an income tax implication perspective, whenever there is a capital reduction, the thumb rule is that to the extent you have accumulated reserves, and to that extent that capital has been paid back to the shareholder, to the extent of accumulated reserves, you will treat that payment as a dividend, and over and above, you will test it for capital gain or a capital loss. So just to give an example, let's say I'm a company, my accumulated profits or my reserves are 20 crore. I have carried out a capital reduction where I have paid back 30 crore to the shareholders by canceling their shares or reducing their face value or whatnot. In that case, the first 20 crore will be regarded as a dividend paid to the shareholders, on which appropriate implications will arise. And the balance 10 crore will be tested for capital gain in the hands of the shareholder. That is how this works. There have been some very interesting cases, where many times you carry out a capital reduction, but those capital reduction is merely a reduction in the face value. And many times the tax office comes back to say, you know what, I'm not going to allow you a capital loss because your number of shares remain intact. You were a shareholder, you held 10 shares. Even after the capital reduction, you continue to hold 10 shares. Of course, your face value has reduced, but your shares remain same. And because your shares have remained same, where is the transfer? And if there is no transfer, where is the question of a capital loss? Now, in my view, now that issue has been settled by a recent Supreme Court case in the case of Jupiter Capital, where even a reduction in the face value has to be treated for a capital gain or a capital loss. So merely because my number of shares remain the same, the tax officer cannot argue that there is no transfer. It will be deemed to be a transfer. Similarly, there have been cases where you cancel the shares, but you do not make any payment to the shareholders, because the situation of the company is in distress. So you are actually right sizing your balance sheet, but you are not making any payment. There have been some cases like Bennett Coleman, etc., where the tribunal has held, what, no payment has been made, and therefore there is no question of any capital loss. But again, the special bench, now recently we have the Tata Sons decisions. I think all those decisions are rightly taking a favorable view, which basically says no, irrespective of whether I'm making any payment or not, the action of a capital reduction gives rise to transfer, which obviously will lead to a capital loss or a capital gain. Obviously, a capital loss because I'm not getting anything in return. So, to that extent, I have believed that all these tax controversies, which were there for the last 5 to 7 years, hopefully in the last 6 months, due to some of these decisions, especially the Supreme Court decision in Jupiter Capital, has now been settled. So, we can rest assured that yes, if there is any capital reduction happening in a company, where the shareholders are not getting back their capital back, they can obviously claim a capital loss to that extent. Buyback of shares. Uh, Commercially, a buyback of shares was akin to a capital reduction. In a capital reduction, my number of shares reduce and I get some payback. In a buyback, the same scenario used to happen. The only reason why buyback was more popular, that a capital reduction required an NCLT process. One had to go to a national company law tribunal. A buyback could have happened through a board of directors, at most through an AGM approval. What the government has done it is that they have changed the laws, since last year, where they are deeming a buyback to be a distribution of profit, which is taxed as a dividend, and your cost base gets converted into a capital loss, which of course I think is very, very illogical, but that is how it is. So just to give an example, earlier listed companies would carry out buyback of shares. When a buyback of shares was carried out, the typical shareholders would offer capital gains against those buyback of shares. So if I am getting, let's say, 10 crore, certain shares are being bought back by the company, 10 crore minus my original cost, I will pay hopefully a long-term capital gain on that. And my effective long-term capital gain would be much, much less compared to a dividend. The government felt that this is a way to distribute dividend but pay a lower tax. So they came up with, again, as I mentioned, an illogical proposition that all buybacks will be deemed to be dividend. So now, when I'm selling my shares, I'm receiving 10 crore under a buyback. That 10 crore is treated as a dividend. I have to pay tax as a dividend, which means if I'm a resident in India, I will pay tax at almost 36%. And what happens to my cost base? So let's say those shares costed me 1 crore rupee, right? Ideally, earlier I would have done 10 crore minus 1 crore, a long-term capital gain on 9 crore. Today I'm forced to pay a 36% dividend tax on 10 crore. That 1 crore is now treated as a capital loss in the hope that I will earn a capital gain in future. So this is how the provision is, which in my view has completely killed the whole buyback. I'll be very, very surprised if any listed companies do a buyback henceforth. Uh, but this has raised certain interesting issues for non-resident shareholders, because the non-resident shareholders are under what you call a tax treaty. So let's say there is a particular shareholder in Singapore or in Mauritius. Can he say that while from a domestic tax law perspective, this buyback is treated as a dividend, under the treaty, I will still regard it as a capital gain. And if my shares are prior to 1st April 2018, then obviously there is zero capital gains tax. Yes, this interpretation is possible. So we will continue to have seminars and case laws and judgments and all that on this particular aspect, where a non-resident shareholder might like to wriggle out of the rigors of taxation of a buyback, taking support of a treaty per se. Perfect. We go to the next chapter, which is conversion of company to LLP. Now, as we all know, converting an LLP to a company is much more easier. Converting a company into an LLP, the kind of conditions which the government has put under Section 47, right? It is like only a panwala can convert himself to a LLP, because the condition is that your turnover in the previous 3 years cannot exceed 60 lakhs, which is ridiculous. Because hopefully most of us will have clients where the turnover is much above 60 lakhs, or where the total assets in the books is above 5 crore. So I do not know why are they doing it. And there is a classical litigation or a classical debate that do I at all need to satisfy the conditions under Section 47, which says that this is condition 1, this is condition 2, this is the maximum turnover, this is the maximum asset, blah, blah, blah. Because per se, it is the same legal entity which has changed its character, which has changed its constitution. And if it's the same legal entity, who has transferred and who has bought it? This is like a classical, what you call the Bombay High Court in the case of Techspin, where in the old days, when partnership firms had converted into a company and it was not satisfying the conditions of that particular code, the Bombay High Court said that where is the transfer? Where is the separate buyer and where is the separate seller? It is the same entity which is converting its, kind of constitution. So I do believe that those first principle arguments continue to be available. And hopefully we will have some kind of a jurisprudence built in the coming years, where a high court and hopefully a Supreme Court will say that a conversion of a company into an LLP need not comply with some of those provisions. And we also know that after that, you will have an amendment, hopefully not retroactive, but a prospective, which will say, no, sorry, this is deemed to be a transfer. So they will keep on tightening. So this Tom and Jerry thing will always continue. But today, let's presume that if we have to comply with some of these conditions enshrined under Section 47 for converting of a company into an LLP, what are they? So these are all the conditions. When you convert a company into an LLP, all the assets and liabilities should move to the LLP. All the shareholders of the company should become partners. And in that case, the shareholding which was there in the company needs to reflect as the profit sharing ratio. So if I was a 10% shareholder, then obviously my profit sharing ratio in the LLP will also be 10%. There is one more restriction, that after conversion of company into an LLP, where I'm claiming protection of tax neutrality under this code, which is Section 47, for a period of 5 years, our joint profit sharing ratio cannot reduce below 50%. So it has to remain 50% for a period of 5 years. There is one more condition, which is, of course, the most problematic one, that I can enter this tax neutral conversion only if my total sales or assets are not above a particular number. So my total sales cannot exceed 60 lakhs. My total value of assets cannot exceed 5 crore. Moment I violate one of the condition, I am not eligible to enter into this tax neutral conversion. The next condition is that no other consideration should be paid other than the PSR and the capital contribution. And the last consideration is that once you convert into an LLP, out of the accumulated profits of the company, which is there on the date of accumulation, you obviously cannot distribute that profit to the now partners for a period of first 3 years, right? So significant restriction of converting a company into an LLP. And of course, people have found ways to defeat each of them. Just to give an example, you have an Ahmedabad tribunal decision in the case of Urmin Marketing, where they had a very large company. They merged that company into a smaller company, which was satisfying the condition of less than 60 lakhs. And after the merger, they thereafter converted to an LLP. And the tribunal gave a positive order. Of course, that reconstruction happened before GAR, General Anti-Avoidance Regulations, was in play. So today, carrying out that two-step conversion is far more difficult, because one will have to explain the commercial intent of going through a merger and thereafter a conversion. Again, this whole condition of after conversion, you cannot distribute profits out of the accumulated profits. Again, the way out is very simple. Before the conversion, you convert all your accumulated profits into bonus shares. So now you do not have any item called reserves or P&L surplus. Everything is share capital. And after that, you convert into an LLP. And because at the point of conversion, you did not had any accumulated profits, when you become an LLP, there is obviously no restriction on you to distribute the capital back or the liquidity back. So while of course taxpayers have also tried to find some solution, but the classical debate remains that is this conversion per se a tax neutral exercise? And if it is per se a tax neutral exercise, why do I need to satisfy with all these conditions, right? And we will see more and more decisions on this aspect. With that, let's go to the second module, which is converting a firm into a company. This is much more easy because here you do not have the condition of a 60 lakh turnover, a 5 crore asset, etc. So theoretically, if my LLP is a 100 crore turnover LLP, I can still convert it to a company. And the conditions are much more limited. All the assets and liabilities should shift, they will shift. All the partners should become shareholders in the proportion to which their capital accounts were there. So if let's say there are 5 partners and let's say theoretically each of them had 10 lakhs in their books, then each of them will get 20% when the conversion happens. Again, the same aggregate of the shareholding, because now the partners are holding 100%. For a period of 5 years, they cannot dilute beyond 50% collectively. Somebody can completely exit, but in totality, these partners have to remain shareholders for a period of 5 years, holding 50%. And obviously, no other consideration should be paid other than allotment of shares. So you would see succession of a firm into a company is much more simpler because the legislature presumes that a company is much more tax efficient, because when they distribute the profits, you have to pay a double tax in the form of a dividend. There is only one challenge or one drafting error. And that error is that when you convert a firm into a company, the extinguishment of the LLP interest, which then converts into a share capital, that leg is not expressly exempted. So let me explain. In a company into an LLP, there is an express exemption that all the assets which the company is transferring to LLP will not be subject to capital gain. And there is an exemption to the shareholders also, where their shares are getting extinguished and they are getting LLP interest. It's expressly covered. But when you convert an LLP into a company, the LLP interest which gets extinguished, which gets replaced by shares, that leg is not expressly covered. Thankfully, in practice, we have not really seen any litigation around it. Is it because of understanding of why it should not be taxable, or is it because of ignorance? We do not know. But fortunately, that's an area where we do not see much litigation. Because if a litigation arises, there are some good first principle arguments that why I do not need an express exemption, it should be deemed to be exempted. But this is obviously always an issue. And hence, whenever we talk about succession of a firm by a company, you actually have two variants. Variant one, where the legal existence of that LLP gets dissolved and it gets converted into a company under the process of LLP Act and the Companies Act, which is variant one, where this issue arises because your LLP interest is getting extinguished and whether that extinguishment is a transfer needs to be debated. Variant two, where you keep your LLP intact, create a company, transfer everything to the company, and still satisfy the conditions which are outlined on the slide. And you argue that I don't have to explain whether there is an extinguishment of that LLP interest or not, because the LLP continues. Though there is nothing left now in that LLP, but the LLP continues and I will keep it for a couple of years before dissolving it. So there are ways and means where people have taken one variant against the other variant. I'll skip this sole proprietorship into a company, again, more or less, the same things. Maybe what we'll do, we have 30 minutes left and there are some case studies which we need to cover. There are also some regulatory aspects which we need to cover, and maybe some slides on tax planning versus tax evasion if time permits. But why don't I jump to the case studies, because that might make things more interesting. Now, this is that whole intangible tax planning which I was referring to. A Limited is merging into B Limited. Earlier, what used to happen was that in the course of the merger, a goodwill would get created. And basis the Supreme Court decision in Smith Securities, we would also claim depreciation on that goodwill. The tax office would oppose it, saying that the transaction per se is tax neutral. How can you get this additional tax benefit in the form of depreciation on goodwill? But that was how the law was, and that was how the Supreme Court ultimately laid this issue to rest. This was there for almost 10 years, and I would believe every year I thought they will now remove it, now remove it. Ultimately, this goodwill got removed around 4 years back. So now, if on a merger you have a goodwill created, Section 32 specifically prohibits any depreciation on goodwill. However, it is not necessary that on a merger you will only record goodwill. You will actually record certain intangibles, and goodwill will actually be a balancing figure. So if you are acquiring a company by way of a merger and you are acquiring certain intangible assets, it could be brand, technology, customer contracts, networks, patents, inventions, whatever it is, you're allowed, subject obviously to NDS if it's a related party merger, normally you are allowed to value those intangibles and record it. And there could be certain intangibles which you are not able to identify, which actually becomes a balancing figure, which we call goodwill or a capital reserve. The question is that while the legislature has now specifically prohibited availing depreciation on goodwill, can these intangibles specifically recorded, though in the course of a goodwill, though in the course of a merger, which is a tax exempt transaction, can I claim depreciation on these intangibles? And it seems yes. The amendment does not impact the recording of specific intangibles. So your merger, which could be for a particular commercial purpose, you can also weave in an additional benefit where certain intangibles can actually become a cost stepper and reduce your overall tax liability. Case study 2, a very simple case study. A loss-making company is getting merged into a profit-making company, right? It has happened for whatever, the last 100 years. The only consideration is that can a tax officer apply general anti avoidance regulations to say that the only purpose of this merger was availing these losses, and therefore one has to build in a commercial purpose. There are some FAQs on GAR where it says that if this merger has been considered specifically to be of a commercial nature by the NCLT, then it should be okay. But no NCLT judge will ever pass this in its order. But normally we have seen that a merger is rarely questioned by a tax office. But very important to weave in a commercial reasoning as to why are you merging and taking over this loss-making unit. If you're able to do it at a approximate level or at least at the first case level, hopefully you will be able to defend. And we continue to see these transactions of profit-making companies buying out loss-making companies. But you can't have a software technology business suddenly buying out a loss-making chemical business, right? Just to avail the losses, because you will struggle to explain the commercial rationale of that per se. This is again interesting. As we discussed, one of the condition of a merger is that you have to issue shares to the shareholder of the entity being merged. You have a parent entity which has a subsidiary, we'll call it ICO1. ICO1 has another subsidiary, ICO2. We are merging ICO2 into the parent entity. Basis that parent entity has to issue shares to the shareholders of ICO2, but which is its own subsidiary. And under the company law, you cannot issue shares to your own subsidiary. The question is, will such a merger satisfy the requirement of the income tax code? Answer is yes. These scenarios are specifically built into section 2 and section 47, where in such cases you don't have to issue any shares to your subsidiary. So in the current case, while ICO2 is getting merged in the parent company and parent company is not issuing any shares to ICO1, it will still be regarded as covered under the merger. The second interesting issue which arises is that here effectively, if you look at it, ICO1 has distributed one of its valuable assets, right, to its shareholder, which is ICO2, and it has not got anything in return. Can somebody say that this distribution of asset is nothing but a dividend under section 2 subsection 22? There could be a possible interpretation, but fortunately way back in 1967, the government had issued a circular, some 5P dated 9th October, if I remember, which said that in the course of a merger, demerger, the tax officer is not permitted to look into the dividend aspect. And I think that circular is probably a very good defense where you will stop a tax officer from inquiring whether a particular merger demerger could lead to any deemed dividend under 222. So maybe that circular is, in my view, a God sent defense. Else, there could be interpretation and there could be litigation around it. This is an interesting issue. You have an unlisted company, which is B Private Limited, and A Limited wants to acquire it, but A Limited says, I'm not going to give you cash. I will issue my shares. You do whatever you want to do with the shares. A classic case of a Unilever buying out the Horlicks brand entity. Uh, so what happens is B Private Limited gets merged into A Limited. A Limited, mind you, is a listed company. And the shareholders of B Private Limited are issued shares under A Limited. First question, what would be the cost of acquisition of shares of A Limited for the shareholders of B Private Limited? So let's say I was holding one share in B Private Limited, and now in lieu of that one share, I have received one share in A Limited. The normal answer which people give is that yes, my old cost gets substituted, right? But here there are some interesting provisions under Section 55 where you can claim an indexed cost up to assessment year 17-18 as your new cost. So instead of the old cost, which could be whatever X number, you are allowed to index it up to a particular year, and that becomes your higher cost. So this is a, how do I say, a variant only in the context of Section 55 when a listed company is issuing shares. Second question is whether shareholders of B Private Limited, because see, now I am a shareholder, I have received shares in A Limited. Can I, when I sell my shares in A Limited in future, can I include that taxability under 112A? 112A is a specific code when one sells the listed shares. It gives you a reduced tax rate. But one of the condition also of getting that reduced tax rate, which many times we take it for granted, is that my purchase also should have been subject to STT. So it's not that any shares are covered under that. And when I receive shares under a merger, there is no question of a payment of an STT. So can a tax office says that, hey, you have not paid STT on this transaction. Therefore, when you sell it, I'm not going to give you the concessional tax rate under 112A. So you go under 112, to which there is a notification which exempts certain transactions. For example, a transaction of a merger where I do not need to satisfy the condition of STT payment on purchase. And hence my subsequent sale, as long as I'm selling it on the stock exchange, making an STT payment, will fall under the concessional tax rate of 112 capital A. Okay. This is quite interesting, and it actually is quite relevant for all of us. Does not matter whether we are a large company or we are a small investor. Look at an investor. Let's say I'm an investor in company A, and let's say A is also listed, B is also listed, and my shares are prior to 1st February 2018. The cost of my shares were 10 rupee. The market value as on 31st January 2018 was 50 rupee. Today, when I sell the shares, I do get the 50 rupee as the cost base, as per the typical formula. Now what has happened? A Limited has merged into B Limited today, and B Limited has issued me shares of B Limited today. The question is, will that 10 rupee get substituted, or will that 50 rupee get substituted? Because if you look at the manner in which section 55 to clause AC has been worded, it specifically refers to shares issued prior to 1st February 2018. So if I were to make a literal interpretation of that, because the shares of B Limited, which is a listed company, have been issued to me today, I may not be able to substitute the market value as on 31st Jan 2018. That's because of a very poor drafting. So one will have to make a constructive interpretation to say that that is not the intent. Ideally, my cost gets substituted with the cost which was available. And only through some constructive interpretation, we are able to argue that even for the shares of B Limited, though they are issued today and not prior to 1st Feb 2018, I should be given the cost transfer of 31st Jan 2018. Not a clear view, while we are all taking that view by default, but this is something where we tell, especially large investors who have large stakes and who now have shares in a new listed company, to be cognizant of the fact that there could be litigation around it. I'll skip few case studies in the interest of time, and maybe I'll touch something which I feel are relevant. Demerger of an investment undertaking. As I had mentioned earlier, uh, what is tax neutral under a demerger is when you demerge an undertaking. Many times what happens is that whenever you have a company where you have spare cash, spare treasury, and let's say an investor is coming or you are looking for an IPO, you would like to spin out your extra treasury, land, investments into a separate entity because you do not want the investors to come and participate in your free cash, surplus cash. Merging this extra cash, mutual funds, lend, etc. And the whole question is this an undertaking? And the only way this can be an undertaking, if you take a view that I have two divisions. One division is a business division. Another division is actually an investment division. And this investment division is also run professionally. There are people who look into it. And this investment division, where I have invested into mutual funds, listed stocks, land, other passive assets, is absolutely like a mini NBFC in my division. And it is good if, from an audit perspective, you show in your segmental reporting that I have been showing this two as separate segments. And if you're able to do it, you have a better chance of succeeding before a tax officer that yes, it's a separate undertaking. I'm showing it as a separate undertaking in my audited accounts. And now I have decided to demerge it into a separate entity, and therefore it should be regarded as a demerger litigation. Like you had the Grasim case. Fortunately, they won at a tribunal level where the tribunal said that no, it's absolutely a separate financial division. But you back in, sir, but there the tribunal specifically noted that all the assets and liabilities were not shifted. I think be very careful, and it's a fact-based exercise whether it qualifies as a separate undertaking or not. Perfect. So let's actually the slump sale has a negative value, which means the liabilities are more than your assets. And what you have done it is that you have therefore just, sir, you will say, why will I pay anything? There is actually a negative value. Moment I take that, I might have to bear a higher liability. The whole question is that whenever and against that, the seller has only received 1 rupee. Is that the value of the consideration, or it has to even add the negative value? That is the debate. And obviously, you have decisions on both sides. Just to give an example, I have an undertaking, 2 crore asset, 5 crore liabilities. I'm transferring this to somebody. I'm receiving 1 rupee. Can I say 1 rupee is my consideration? Or do I need to add the negative 3 crore into my calculations? My view, my personal view, you might have to add the negative 3 crore into calculation till you have a Supreme Court decision saying that no, you're not allowed to use this as a consideration, because anybody who takes over a liability effectively is giving you a consideration in the form of taking away your liability. So a slump sale with a negative net worth needs to be planned very, very carefully, because you may say that, oh, I'm hardly getting anything, but the consideration itself could be the deemed negative value of this. First of all, is selective capital reduction possible? Yes, under company law, it is possible. And we discussed the case laws of Tata Sons and Jupiter Capital, where if you're not getting anything, you can obviously claim a capital loss against that. Okay, why don't we do one thing? We'll very quickly touch upon, for 5 minutes, the regulatory framework. I wanted to touch on the fast track route. The problem in NCLT is that you have to go to a tribunal and there could be a huge queue depending on the state where you are applying. It could take you anywhere between 4 to 10 months. And therefore, many times we look at, can I do this merger by just going to the regional director, where the typical process time is 3 months. So if you look at the Companies Act, there is a specific section, section 233, which allows for this fast track merger demerger. And they are expanding this route, as we speak. So if I have to compare, the authority in a NCLT route is a National Company Law Tribunal, whereas the authority in a fast track route is regional director. The eligibility for a fast track is only specified companies can opt for it, and I'll come to that specified companies. The biggest advantage is the time frame. You typically can get it done at half the speed, half the time, this thing. Uh, Disadvantage, you need at least 90% of the creditor approval, and you need to have a shareholder meeting, compared to an NCLT where only the creditors who attend the meeting need to vote and you need 75%. So in a fast track, you'll have to chase every creditor, whether they attend the meeting or not, and take consent of at least 90%. And the last is that you have to be a solvent company. You cannot be an insolvent company and get into fast track, whereas under an NCLT, even an insolvent company, like you don't have to give a certificate of solvency. That's so there are certain rigors of fast track, but if you're able to satisfy the 90% creditors, solvency test, uh, being one of the small companies, I'll come to that criteria, then this is one of the fastest route of getting a merger demerger done. What are these companies which are eligible? You can do a fast track merger between two or more small companies. And what is a small company defined? A company where paid up capital is not exceeding 4 crore and where your turnover is not exceeding 40 crore. So if you're fitting into it, you're a small company, you can absolutely merge or demerge with another small company, wholly owned subsidiary. Here, size doesn't matter. These two could be giant companies, but if you want to collapse your subsidiary, wholly owned subsidiary, into the main company, then also you can go under the fast track route. You don't really need to get into an NCLT route. They have further expanded this by way of some notification in 24 to even include startup companies. Now, becoming a startup company is not very difficult. You have to just register with DPIIT. There, typically, if you're a company with less than 100 crore turnover, under a specified activity, etc., you do get a startup certificate. This is not a startup exemption certificate under ATIC. This is just a startup certificate under the DPIIT rules. So if you're a startup company, even this company, you can merge with another startup company or with a small company. So they are expanding this fast track eligibility. And now there is a draft rule which are covered where they are proposing to further expand it. So for instance, they are saying is that you don't have to have a wholly owned subsidiary. Any subsidiary can merge in its holding company. So if I'm a holding company, I have a 60% subsidiary, I want to merge that 60% subsidiary in me. The draft rules, they are yet to be notified, but they are saying, yes, you don't have to go to NCLT, you do the fast track route, it's perfectly fine. So this is a route which we are going to see more and more coverage, and it might give us more options to actually go to a fast track rather than an NCLT. There is only one tax controversy you should remember. Whether a demerger under a fast track is tax neutral or not is a matter of litigation. My personal view is today, a demerger under a fast track is covered under the tax eligibility. But when you look at the income tax bill of 2025, which obviously is going to go through many, many changes, there they have specifically excluded demerger from the overall definition for tax exempt. So we'll come to know in few months whether the government is covering it or not. I'm pretty sure there would be recommendations which would have made. So let's take very few examples, and maybe let me take this example. You would have heard about foreign companies merging back into the Indian company. So this is one case study where a foreign company has a wholly owned Indian subsidiary. Normally, if you go the NCLT route, you might take anywhere between 8 to 10 months. But the government has come up with a specific fast track route saying that you don't have to go to NCLT, take an approval from RBI, take an approval from regional director, and you can get this flip done. So this time process can actually be shortened materially. That's one example of a reverse flip. Uh, Issuance of bonus debentures. There is one classic tax planning available where on a merger, instead of issuing shares or equity shares, you can actually issue redeemable preference shares or bonus debentures so that your future outflow can be in the form of interest. And this is more popular amongst unlisted companies. So this is one which you have seen SR Entertainment, one SR Enterprises. So couple of companies are using this. So this could be one more way where you want to change your capital structure, especially in an unlisted company, to have certain debentures instead of capital where interest can be paid, which is deductible and taxable. So it does away with the rigor of a dividend, which is an additional 36%. Then you can actually look at a scenario where on a merger or on a demerger, you actually have bonus debentures, bonus RPS being issued, etc. per se. Uh, GAR is uh, a very important criteria. So there will always be a question that what you are doing, is it a legitimate tax planning, or is it an aggressive tax planning, or is it tax avoidance? So simple point is that you will have to pass the GAR test, which simply says that whatever transaction you are doing, the main purpose of it cannot be tax benefit. Can tax benefit be one of the purpose? That is allowed, but the main purpose cannot be tax benefit. So you will have to demonstrate a commercial purpose to be the primary purpose. And one of the other objectives or one of the other purposes could be tax efficiencies per se. And there are host of four step test, which will not go through it right now. But this is a very important factor in whatever M&A planning, we do in future. Any questions? I'm happy to pick it up, or we'll conclude for today. Thanks a lot for the patient hearing. Yeah. Sure.
I don't think there are any questions.